You're listening to BFM 89.9, the business station.
Today on the Breakfast Grill, we welcome Teng Chee Wai, the Chief Executive and Executive Director of Hwang Investment Management Berhad. Now, of course, Teng, welcome to the show. You are the founder of this firm. You started the outfit in 2001 and you've grown it from about 20 million ringgit in assets under management to about 13 billion ringgit in assets under management. So 630% increase, 630-fold increase in that period of time. What has helped you along the way, along this path of becoming one of the big hitters in the local asset management field?
I think the key to the asset management business had been having the right people. And I think over these last 11 years to 12 years, we had actually gathered a good team of talents, basically from sales, operations, and more importantly, to investments. Our philosophy is that we believe this business consists of three key pillars. The first pillar is performance. You can't run away when you are managing money for people that you need to deliver performance. We are not talking about short term, but at least over a 2-3 year horizon, a decent performance. Secondly, you need good people to review. You need talented people. The last pillar is the products. We need good products over time to be in the marketplace, products that can withstand time, products that can be applicable through up and downs of the market.
Teng, on the second point that you raised, in an era of the Madoffs and the Creviels and the Leesons of this world, how difficult, or in fact, how important is it for you to identify integrity earlier on in the people that you hire?
It is important. In fact, one of our core values that we have for the firm is integrity. In fact, it's the first of the three. And from my early days when I first started the firm in 2001, I've been questioned left, right by people to ask me, are you sure? How can we trust you with our savings? How can we be assured that you guys will be prudent with our money and it's not other people's money? And my answer to them is that really it's only over time that we can prove to you that we are a group of people who are honest, who are out here to do the right things. And I think so far the values that we have established, integrity has been well practiced within the firm. Anyone that walks through the firm knows that integrity is important to us, and anyone that is found to be of doubt will be removed without any question.
But how do you identify? I mean, what kind of data points tell you that a person is trustworthy or is a person of integrity when you meet them for the first time? It's pretty tough.
You can't tell actually for the first time. You will have to work with them over time to know. And I think that's sometimes the draw of luck. And I think these are basically experience that I've gathered over the years. My philosophy, I give them benefit of doubt. I like to give them benefit of doubt from day one. It's only when the trust is broken, that's when I will withdraw the benefit of doubt.
You've grown it from about 20 million ringgit to 630 times the size to about 13 billion, roughly give or take a couple of 100 million thing. You've gone public with a plan to grow this asset size to 20 billion within the next 5 years. Now, how are you going to do this?
I took 10 years to get to 13. I think it's a reasonable expectation. We have learned a lot along the last 11 years. We've learned what are the right things to do, what are the wrong things that we should discard. We've learned what products take us to the market, what are the products that just don't sell. We learn what is the necessary skills that is required to retain client, and how do you reach out to clients. So we have to come up with different programs, different products, different market segment to basically address them. Have we covered the entire market in Malaysia? The answer is no. If you do a poll of Hwang Investment Management, it's still relatively unheard of in Malaysia. And I think there's still a big market for us. Bear in mind, private retirement scheme is coming in by this year. While we have applied, we may or may not be chosen, but we think that there's a great excitement for the industry, not in the short term. In the short term, lots of education have to be put into it, but over longer term, it will be a great an alternative for Malaysian publics to save their money.
Now, as we understand, the total assets under management within this industry is about 105 billion ringgit. Is that about right?
Depends whether you add on PNB or not. I think if you're talking about the private sector, then probably about that.
About 105. Okay, what can this market be, though? I mean, what kind of quantum larger can it be?
Put it the other way. If you look at the asset growth of the industry has been growing at the double digit. Look at the savings rates of the country, it's also been growing at the double digit. So I think if you use them as a yardstick, my own sense is that the industry should be able to grow at the 10 to about the 12-13% compounding rate over time. And if you are more aggressive and you are probably coming up with more products and be able to garner more assets, then probably your growth can move up to about 20%. And then with that 20% target, we should hit our 20 billion target.
Okay, within the next 5 years. Okay, so now, Teng, you're in charge of basically managing the business in terms of accumulating funds and setting the product strategy for the group going forward. And you've got a broad macro view of the markets and economies going forward. So talking about the product strategy issue right now, where do you think the innovation should take place in terms of developing products?
At the moment, most of the products that are selling are very much close-ended bond funds, guiding certain amount of coupons above FD rates.
Is this a reflection of the volatility in the market that people are seeing that stock markets are too turbulent?
It is a reflection that people are just not sure what's happening in the marketplace. It's a reflection of low interest rate environment that they are tired of, but also reflection that investors want certainty. Although the targeted returns is only probably 1.5% above the FD rate, they're fine as long as they have certainty of time, certainty of coupon. That's what they want, and that's how the market is evolving at the moment. You ask me, is it a healthy trend? Definitely in the short term, that's what we are seeing. In the long term, what we hope to do in Hwang, which we have been doing for the last 5 years, is to continue to come out with dividend-yielding, income-yielding products, and that delivers regular dividends to the investors, although open-ended, but produces a much more superior return than the closed-ended funds.
Why this discrepancy? Why the attraction towards closed-end funds right now as opposed to an open-ended fund?
Because of certainty of time to get back the money. And I think that's the perception, that once I lock in for 3 years, I know at the end of 3 years, I get my money, I get my 4.5% coupon, I'm happy with it. Whereas if you buy an open-ended bond fund, and you look at the historical long-term return, it has been 6%, you probably is better off buying the bond fund. But there's no closure to those investments. I think what investors are used to at the moment, because of their long-term affinity to deposits where there is a fixed maturity to it, I think that's the mindset they are locked into it. So I think we hope over time that people would continue to be open-minded on even as you are invested in open-ended funds. There's no lock-in to it. You can withdraw anytime you want, and those investments do produce a better return than the closed-ended bond fund.
Do you see this window, the attraction towards closed-end funds and the certainty that comes along with it, do you think it's a temporary one, or do you think that people will start moving towards risk-on assets in the foreseeable future, earlier than later?
I think you'll be in here for a while. If you look at the way markets behave, it has been a very difficult market. Just when you thought it's dangerous, the economic data are weak, and it's not the time to get back to the equity markets. In January, the market rebounded double digit. And at some point down the road this year, when the economic data start to show confirming trend of recovery, and you start to meddle into it, you realize that that's the end of the market. So since 2008 until today, that's the nature of the market. The cycles are short, and when you think that it's time to get into the market to take on risks, you get yourself burned. And when you think it's not the time to put in money, the market just moves, although you think there's no fundamental supporting those movements.
Okay, so given this turbulence, right, a vast majority of your funds under management are through retail individual clients, but quite a good percentage of them are institutional, in fact, GLIC type funds. Now, are there a differing spectrum of appetites from each side of the client market?
There are. The institutional funds investor in equities, they understand the equity market risks, and they look at things over a longer period of time, typically over 3 years. That's how you are measured. And I think in Malaysia, what happened is that most of them sets certain return on investments that you're required to realize for them. Between the institutional investors and the retail investors, there is a difference. Institutional investors tend to be longer term. They tend to focus on return on investments on a realized basis, whereas the retail investors invest more on thematic, seasonal stuff, which sometimes we hope, and we are basically out there trying to convince them the way to invest is to really invest on a holistic basis. Look at income, look at dividend and fixed income, have a good balance and asset allocation mix.
Last we left it, you talked about how the behavior of individual investors tend to be quite thematic and quite timing driven. Now, as a result, they will get hit by the sales charges and commissions charges. Of course, I think you've got a maximum of 5.5% to get into the fund, and an annual fee of 1.8% a year, of course, as well as some other related sales taxes. Now, this makes it, of course, much more costly for investors because their costs are front-loaded. Now, there's been some calls for reform of this tax structure, this kind of fee structure. How would you respond?
There were numerous discussions before on this particular issue. My sense has always been let the market decide. And there are also products that came through last year where there's no front load, there's no charges at the front end, but there was back load if you exit the fund early. So I think over time you will see that the market will come out with different products to address to different type of investors. What I found out over time in Malaysia is the clients are not sensitive to charges. Clients are more sensitive to service quality. And I think that's probably where the differentiation will have to come through. Secondly, really, if you invest over long term and amortize the front end over a period of 3 to 5 years, you find that it's not really an exorbitant fees to pay off. However, if you are trading unit trusts like some of them do, then it's definitely not a viable investment at all for anyone who like to trade unit trusts. Here in the industries, I would rather say unit trust is meant for your long-term savings, not for you to trade in and out. It's not like a stock per se.
When you talk about service quality thing, presumably you've got people on the ground who will have various touch points and interacting with the clients. And how would you up the game in those respects?
I think you need to upgrade their knowledge in investments. Generally, for Malaysia, our level of understanding of investments is still pretty low. Although I would say the last 10 years as I started the industry and now, I noticed average man on the street, because through the advance of internet, have learned a lot about investments. However, the trick about investment is not just listening to Bloomberg and CNBC in the morning and then decide what to do. It's about ability to interpret the events and see how they apply to each of the different investments. Everyone will have access to the same information over time. But what sets or separate what the one that's doing well with one that's not doing well is how do you interpret those noises or those news out there.
Well, at one point, unit trusts was the darling on the block. Everybody wanted to buy unit trusts, but it's become a bit of a slightly more mature market right now. People now think that if they can go direct into the market and have their own positions, then they don't need to be encumbered by the fees and charges. Then do you find that the unit trust industry, the growth is kind of tapering off as a result of that?
Not really. In fact, as I watch other developed markets and the way those markets develop, what most people found out over time, well, yes, it's nice to meddle with the market, it's nice to go there, and Koyo reminds us, you trade a stock, it goes up a bit in a day, and you feel excited about it. But in the long run, I think most people would tell you that if you do not have a good investment philosophy in the markets, you tend to lose money anyway. And I think in some of the markets I've observed, people tend to turn to unit trusts as a long-term savings tool, a long-term savings vehicle, rather than through the markets of meddling it themselves, because there's just so many stocks out there. Which one do you buy? Which one do you keep? And which one do you invest in? I think Malaysia will go through that phase. We have a rush in 2006, 2007. We have allowed the last 2-3 years. We are starting to see investors coming back to unit trusts as a form of investments.
Now, I think on exactly that point, don't you think that the fee structure has got to come under some kind of reform? Because if you were to buy your funds or, similar funds from the EPF, you would only pay, 3%. But if I come out from the external environment and I come and buy your fund, I pay 5.5% to 6% Now, why is my money in EPF more valuable or, less or more valuable than the outside fund? I mean, there's this dichotomy going on.
The reality is that if you actually look at all the promotions, while officially it's stated 5.5%, the reality is that there's a lot of promotions out there. And when one finally dissect the promotions, the cost of the promotions, the actual upfront fees that are paid, it will not, in most of the time for an equity funds, it will not be more than 3 to 3.5% because of the promotions that have been given, especially for those that have size. For me, as a fund manager, we hardly earn any of the fees from our finance charges. We give it all to our distributors, and it's up to them how they want to dissect and cover their marketing costs, because there is cost to market these products. And as far as we are concerned, we just use the back-end fees as our main revenue stream. That's the philosophy of the firm. And the 5.5% charges that we have for some of the equity funds is there because of the way the industry had been in the past.
Okay, the third leg of your job scope within Hwang, of course, Teng, is your view on broader markets and where the broad directions of the economies and markets are going. Now, we nearly came and touched the record high of 1597 on the KLCI, but we didn't get there. Then we've come off a little bit now. It's been like that for the last 2 or 3 weeks. It's been a bit sideways and a little bit cautionary. What's your view on the KLCI and share markets, even in the region, for the next 3 to 6 months?
If you look at the big macro at the moment, my sense is that 2012, on the margin, is better than 2011. It surprised a lot of people when I said that, because you look at US, Europe, and the emerging markets, the issues confounding these markets in 2011. For instance, US, after the month of end of first quarter last year, the economy started to slow down. Today, we are having probably about the 23rd week of economic recovery in US, and it's a lot more broader from just, not just employment, but also housing and across the segment of the economy. Last year, we had the blow-up of the European debt crisis. Greece was at the headlines all this while. Today, we are having a period where probably we are closer to the end of Greece. It's not that Greece will recover tomorrow, or Greece will be completely okay by tomorrow. It's just that we will probably ring fence the issue of Greece after it has been declared default, and the Europeans can move on from firefighting to focusing on growth. On the inflation side, last year there was great inflation pressure on emerging markets. Today, inflation in China that was just released over the weekend is closer to the 3%, rather than last year was closer to 6%. So I think on the margin, things are on the macro side are getting better, but we do not pretend that we are still in a global consolidation phase. As far as if you look at the world, even in a much bigger picture since 2008, each of the global bloc are having issues, economic issues, from US to Europe to Japan. And as such, what we are seeing is that there is uneven growth that we are facing. There's a consolidation that we are seeing. And when Fed set zero interest rates up to 2014, it tells you that that's how long you will have to wait for that consolidation to be over. We had these periods where growth is just not there for a long period of time, and markets are not doing much for a long period of time. Back in the 70s, when markets were consolidating, then I think we are back into those modes. So there will be into this consolidation, the markets are still trading. There were periods where they are up 15-20%, and they just come off after that. So the cycles are very short, and you have to be very careful when you invest in markets these days.
Hence the trend towards closed-end income-based funds. There's also the added uncertainty in Malaysia of elections. Of course, elections, and the government in Malaysia, they have the luxury, they have the surprise effect of calling elections at the drop of a hat. Now, of course, this doesn't lend a lot of certainty to markets. How are you pricing and how are you playing the election uncertainty here?
I think if you look at the checklist, if you want to have a checklist on issues that have to be resolved before elections, I think one will probably see that there's a fair bit of ticks that have been done. For instance, PKF's Act issues. Now the national feedlot issues are being addressed. That has publics that have been not happy with, and I think a lot more. There have been the implementation of MRT is starting off. I think the sense that we have on the ground is that elections will probably be sometime in the middle of the year, and I think market is basically expecting that although it's at the prerogative of prime ministers, nobody really know the actual date. But I think the sense of the market is probably at the middle of the year.
Okay, of course, we've seen various funds like the EPR, for example, being in the news for disposing a large chunk of their holdings. Now, of course, whether it's a storm in a teacup or it's a longer part of a longer-term trend, we don't know. The argument goes that, with elections come uncertainty, and when polling date is announced, people sell their shares because they don't want to carry this uncertainty. Now, what is Hwang's position on this? Are you holding a large amount of your AUMs in cash right now, or are you trying to time the market? What are you doing?
Currently, our portfolios have about 20% cash in them, generally, into the consolidation. Into the run-up of elections, our sense is to raise some cash. We would like to lighten a bit on portfolios. Those politically linked stocks, construction stocks in particular, we like to lighten them because we think that if there are different outcomes from the elections, there are implications on a number of these companies. Where we are keeping our holdings are really in things that are neutral politically, like, say, consumer stocks. They are very neutral, and not wanting too much exposure to a number of sensitive political stocks.
Well, without having a crystal ball in front of you, Teng, we don't really know how the elections will pan out, except to say that they will have to happen at some point in time. How are you playing the various permutations? Because, of course, if outcome A and outcome C are vastly different, and it will have a big bearing on the period of uncertainty.
As I said in some of my meetings, the outcome of elections, what we hope is something of certainty. The last thing we'd like to have is a hung parliament, where any one parties, any one groups win with a slim majority. I think that really will create a lot of uncertainty for foreign investors because you take the risk of changes in the parliament. So to me, that's the worst outcome, the worst case outcome of the election results.
And how would you rate the possibility of that happening on a percentage basis, 100% being the most likely, 0% being the least likely?
I think there's a 20-30% chance of having of that outcome. I think at the moment the consensus still believe that the ruling majority, Barisan Nasional, will still win with a reasonable majority. It may not be 2/3, but reasonable majority that can form the government. I think that would ensure continued stability from the perspective of foreign investors.
Okay, last question. 2008, how did Hwang do in those periods, and how did you deal with this massive sell-off that occurred as a result of March 2008?
2008 was an interesting market for us. When we ended 2007, we look at markets valuation, China at 40-50 times PE. Markets were jubilant with 4 years of unbroken regains. We decided to raise cash at the end of it. We said, let's walk away from the market because valuations are just too high. So we raised 20% cash in 2008 January, and we thought we were doing well when the market started to decline. Bear's turn came sometime in March 2008. JP Morgan came in to rescue it. We thought that was the bottom of the market. So we decided that it's time to get back in because markets came down. And by May that year, May, June that year, markets continued to decline, and we sat down and we look at it. There's something that's wrong with the market from a technical perspective, but we can't tell because it's just very quiet on news flows. We decided to walk away from the market because we have broke all our sell levels, our portfolio loss levels, they've all broken down. And we raised 45% cash during that period of time. We cut loss. What we did was we took out our portfolios, every single small caps that we have, anything that is high PE, anything that is non-cash generative in their business model, we just clear the portfolio, lock, stock and barrel, and cap whatever that's dividend yielding, good cash flows, and things that we can justify that will survive the game. That was a wise decision, but it was a tough decision, because if you were wrong, the market rebounded, we will look like fool. And we sat throughout that period of time from the month of May, June, all the way as the events unfold finally in November, December. And it's only in following year in 2009, January and March, we went back into the market. Now, even after doing so, cutting our losses, getting out from the market, it's not that we didn't lose money. But the markets were down 40-50%, our portfolios were down about 20%. But what is important was not just about it declining 20%. What is important is that when the market recovers, sometime in the early 2009, we had a lot of cash to invest.
Well, hopefully that experience with the last GFC will give Hwang the experience it needs to perhaps take some of this, to assume some of this uncertainty that might happen in 2012. We don't know, because we don't have crystal balls in front of us. Again, thank you for your time, thank you for your thoughts, and good luck with the portfolio management business going to what is going to be otherwise a very turbulent year. That was Teng Chee Wai, the CEO and Executive Director of Hwang Investment Management Berhad, BFM 89.9.